So very good afternoon, friends. I guess you have taken out time to make some revision. So I think let's make the best use of this. How do you want me to deliver the lecture in a mix of Hindi, English, or purely in English? So I think let me just get some inputs from your side. Mix is fine. Okay. I think I'm getting a few inputs English, but majority is on a mix, I guess. Okay. So I guess Hindi would be more preferable. Mix means a mix of Hindi and English combined, I guess. Okay, I guess Hindi English mix. So I don't know Hindi at all. Okay, so in between, maybe to give a little flavor. So I think we'll give it a little mix, I guess. So whatever I'll say, I'll put it in English and Hindi both. Okay, so let me tell you what is the agenda for the day. I have basically taken a couple of questions from the past examination. And just to ensure that you have not done those questions earlier, what I've done, I picked up these questions from some past examination kits. The idea today is not only to revise, but also to give you confidence in terms of what you've learned so far, that if you face a new question, can you handle that or not? So don't get disheartened if you're not able to answer questions in between. But you know what we'll do? I will share these screenshots of the questions to you in the chat box, but I'm planning certain things. Let me tell you what is my plan of action. I'm basically going to make a revision of section C questions with you, where the focus is going to be on chapters like cost of capital, chapters like business valuation, chapters like working capital management, comprising of inventory, comprising of receivables management, etc., and on the investment appraisal. Today, I'm going to focus on questions from the chapter of cost of capital, working capital management, and business valuation. Tomorrow, we're going to focus on questions on investment appraisal. So my plan of action is that I am going to first quickly give you a run on the concept, and then we'll start solving the questions with you. And if you're confident that we don't want a run of the concept, then I think we can directly jump to questions as well. But I personally believe that I think we should first make a run of the concept, and then we can probably come to the questions. So what do you say? You want me to take a quick recap of the concepts of cost of capital and then come to the questions? Important run of the concept. Okay, that makes sense. So what I'm going to do, I'm going to first take a run of the concepts. During the run of the concepts, you are free to answer questions if you want, and if not, it's fine. Okay. So do the past year questions that repeatedly get repeated for section C. Yes, we will do questions on that. Okay. So I'm going to first share my board. Let me know if the board is visible to you, because the concepts, I'll run it on a board, and then we'll solve the questions on the Excel sheet, because you need to do these questions on the Excel sheet. So we're going to solve this on the Excel sheet itself. Okay. So if you want, you can start noting down as well. So when I look at the chapter on cost of capital, I think it's one of the easiest chapter. We know that company can raise finance through various sources. And I think typically, if I just try to recall what are the different sources of finance, I would say the different sources of finance is: number one, cost of equity; the second is preference; the third is debt. And then you've got basically these three sources. I would say one is debt, one is equity, one is preference share, and term loan, of course, will get contained in debt itself. So I'm going to start my inputs with the first one, and that is cost of equity. Now, when we look at the cost of equity, you all already know that cost of equity is symbolically represented as KE. K stands for cost and E stands for equity. And there are a total of two models which gives you the cost of equity. Which model is to be applied in the question? That is dependent upon the data which is given in the question. So in the meantime, if you want, you can tell me which two models are there. when you calculate a cost of equity, so कौन से दो models available हैं? That's right. One is a dividend discount model. One is a dividend discount model. I call it as a discount model. You can call it as a dividend valuation model as well. That's perfectly fine. And the other one is what is called a CAPM, that is capital asset pricing model. Now, I'm again reiterating, you need to be very careful in the questions, because I have seen certain past examination question where the examiner, gives you information on both the kinds of model, but he misses out intentionally on one particular information. So he wants to test your knowledge that looking at the data available, can you decide that it is a dividend discount model or is it a CAP model? Now, when you use a dividend discount model, generally there will be growth. So I'm assuming that the growth is there. So when the growth is there, we can say cost of equity is equal to D1 divided by PO plus G. Now, there are a few things which needs to be kept in mind very clear, where people generally tend to go wrong. So there are a few things which you need to be very careful on. Number one, when you consider the price of the share, is the price of the share ex dividend or is it cum dividend in nature? That's very rightly said. So we need to consider the price of the share. It has got to be ex dividend in nature. Now, when it comes to the concept of D1, D1 basically means that it is supposed to be the expected dividend. So when we calculate a D1, he will give you the dividend which is just paid. So we will take D0 plus the growth factor. Now, let me ask you one or two more questions on this. When you consider the concept of D1 is D0 plus DG, now the question is, there are two kinds of things which you will see. The question sometimes says dividend is just paid. If it says dividend is just paid, that means, of course, he's giving you the information on D0. And sometimes he tells you that dividend is not yet paid. Dividend is about to be paid. I'm sure you would have witnessed that information in the question. The dividend is about to be paid. So even if it says dividend is about to be paid, that indicates D1. Now, I have a small question. When you say dividend is just paid, the price of the share is supposed to be X or cum. When it says dividend is just paid, then the price of the share is supposed to be X or cum. And that's right, it becomes a X dividend price. And when it says that the dividend is about to be paid, then in that particular case, is it cum or is it X? And then it becomes a cum dividend price. So you need to be careful on the language of the question. So I think this is one input which you need to be careful on. Now, as far as G is concerned, either it is directly given or maybe he gives you a pattern of dividend. Maybe he gives you a pattern of dividend. So from the pattern of dividend, we will be able to get the growth factor into account. So this is as far as the concept of dividend discount model is concerned. The key inputs, you need to be careful on the price, that it is X dividend quotation. The D1 is the expected dividend, which is the current dividend D0 plus the growth. Now coming to the CAPM model. Now in terms of CAPM model, the cost of equity is supposed to be a risk-free rate plus beta times the return from market minus the risk-free rate of interest. Now, the quick question again is, when you take the difference between RM and RF, what do you call this in short as? That's right, it is called a risk premium. Sometimes the examiner may not give you the information as far as the risk-free return, the return on market portfolio is concerned. No worry, if he gives you a risk premium, then we'll just multiply the beta into the risk premium itself. Wonderful. Now let me ask you a little off-track question. Can I do that? Yes, I can do that. So tell me, this beta is supposed to be which beta? Is it asset beta or is it supposed to be equity beta? And that's right, it is supposed to be an equity beta. So when you go to consider this beta is supposed to be an equity beta in this case. Because when we say it is asset beta, in that particular case, it is supposed to be what you say an ungeared company. The moment you say it is an equity beta, it is a geared company. Though in capital structure, you would remember the concept where the beta is first of all ungeared, then it is regeared, and then the concept of KE is applied. I'm just thinking aloud. I'm just thinking aloud. So I think I got some wonderful answers indicating that you're quite well prepared in terms of the cost of capital chapter. Great. Let's go ahead. So this was one element. Now let's come to the second element. The second element of cost of capital is supposed to be called the cost of preference shares. The second one is called the cost of preference shares. Now, in terms of preference shares, symbolically, when you represent the cost of preference shares, it is symbolically represented as KP. Now, when you calculate the cost of preference, it is quite simple and straightforward. KP is supposed to be D upon PO. So in this particular case, we don't have the concept of D1. It is simply the concept of D, because dividend on a preference share is going to be, you can say, constant all throughout. And similarly, just like you did in terms of equity, this price is also supposed to be taken as a ex dividend quotation. So when you consider the price, whether it is KE or it is KP, we need to consider a ex dividend quotation. Preferences, I think, simple and straight. Now comes the third one, and that is considering the cost of debt. The cost of debt is supposed to be symbolically represented as KD. D represents for debt, K represents for the cost, and it is KD. Now, the moment you calculate the cost of debt, can I say what comes to the mind is two things. Either it is traded or it is not traded. So we'll divide this in two parts. The cost of debt is supposed to be either, you can say, traded, or we can say that it is not traded. Traded in the sense that it is either quoted in the market, or when we say it is not traded, it means it is not quoted in the market. So tell me which debt is not traded. Because when we see traded, there are going to be some variations we'll see. So tell me which particular debt is supposed to be not traded. And that's right, it is supposed to be a term loan. Wonderful. So not traded means that we're looking at a term loan. So when I say term loan, in this particular case, you can directly consider this as KT. So in this case, we take the interest, and the interest is taken net of tax. So it will be 1 minus T. Now, just a quick input, because this is something which can trouble us in exams. Now tell me, when you consider a KT, this interest is supposed to be what? In an absolute digit, or is this supposed to be in a percentage? When you look at a cost of term loan and you consider this I, that's right, it is supposed to be taken in terms of percentage, not absolute. It's taken in terms of a percentage. Wonderful. Now, when it comes to a traded one, so we've got, three inputs. One is called irredeemable, and one is called redeemable, and the other one is called convertible. The other one is called a convertible. So I think let's first of all quickly get the inputs in terms of irredeemable as well as redeemable and convertible. So when it is irredeemable in nature, we symbolically represent this as KD. Can I say this is going to be the I, that is the interest into 1 minus T net of tax, divided by, you can say, the market value. Now, the question is, in this case, when you are considering the calculation of I, is this I in an absolute digit or is this in a percentage? Now you're dividing it by the market value. So in this case, it is supposed to be the absolute figure, not a percentage. So these are, small little minute inputs which we need to be careful upon. If you're careful, then you cannot lose marks on this area. So when you take a term loan, the I is in a percentage, but when you take the debt, then it is supposed to be in an absolute digit, and then you divide it by the market value. Now, when it comes to redeemable debt, I think you can give me in a single line. What exactly are you going to do if it is supposed to be a redeemable debt? Wonderful indeed. So we need to directly calculate an internal rate of return in this particular case. Your answer of the IRR is going to give you the input in terms of redeemable debt. Wonderful. Can I say even in terms of convertible debt, we will consider the internal rate of return, but the only input we need to consider is you need to compare that at the end of the tenure, is the holder going to consider, that I should get cash or I should get the money in terms of share. So we will evaluate which is the best option. That's rightly said. So we will evaluate what is the best option in this case. So the best option would be, you will consider that, okay, let's consider that if he takes shares, then what do we get? And if he takes cash, then what do we get? So you'll have to evaluate in this particular case. And yes, that's right. The IRR based on the floor and as per the question. So you can say it is, based on market value or the floor option, whichever is greater. So the best option, that whether he should go for shares or whether he should go for cash, and accordingly we will decide and calculate IRR. Wonderful. So I think I am feeling confident that you know the concept well. So I think you should also be feeling confident as well. Now, once you've derived all these inputs, individual elements in this particular case, then what do you need to do? You need to calculate a WACC, a weighted average cost of capital, which can be computed based on two factors. Either we can take the weights as the book value weights, or we can take the weights as market value weight. Unless mentioned otherwise, what do you think, which weight should be considered in the exam? So if the question is silent on the agenda, that's right, we are going to consider the market value unless mentioned otherwise in this case. Wonderful indeed. So I think we have made a very quick revision of the different elements, components of working capital and the concept of WACC. So are we ready to do a question now? I think I did the revision. Now you need to do the question. Of course, we'll do it collectively, but that we'll do it on the Excel. So let me do one thing now. I am going to now use the Excel sheet. I am going to share the question to you on the chat box, and we'll just spend some time first reading the question and then we'll solve it out. I'm just going to share the question to you. Just give me a second. I'll share the question in two parts. See, did you get the first part? Sir, if the question asked in book value and market value, how do we do? Then you'll have to calculate both of them on a separate basis. But if the question is silent, then you need to consider market value only unless mentioned otherwise. Okay, I'm giving you the second part of the question as well. Just a minute. So I hope you got the question. The two parts, you can download them and keep it with you. So just let's, I think, read. I'm going to share this on the screen as well so that we can read the question carefully. So I'm just going to share the question again on the screen. Just give me a minute. I'll just share it on the screen, then we'll solve it out. Okay, let's read the question with you. Here goes the question. It says the following statement of financial position information relates to Tufa company, a company listed on a large stock market which pays a tax rate of 30%. Tell me, first of all, have you done this question earlier? Or are you doing it right now for the first time? Because I have intentionally, taken questions which are from here and there. You done it earlier. Very good. Shallow. Then it's great if everybody's done it. Oh my God. I thought, maybe people would not have done this. Okay, great. No problems. So it says the following statement of financial position relates to Tufa company A company listed on a large stock market which pays tax at the rate of 30%. Now we're given the share capital, RE, other things. The share capital of Tufa, which is 17 million in the above balance sheet, is consisting of 12 million ordinary shares and 5 million irredeemable preference shares. Well, preference shares are always considered to be irredeemable for the purpose of this chapter. Okay, this is the first part. Now let me come to the second part as well. Here goes the next part of the question, sharing it back on the screen. So it says this is 11 marks. Now it says the ordinary shares of Tufa has got a nominal value of 0.5 per share, an ex-dividend price of 7.07 per share, and a cum dividend price of 7.52. He is giving you a cum dividend price and he's giving you an ex-dividend price. Can you tell me why is he giving you a cum and an ex-dividend price both? So he is telling you what is the ex-dividend quotation and the cum dividend quotation. So why is he giving you both the cum and ex-dividend? So what am I going to do with this data? That's right. We are going to calculate the difference between the X and the cum dividend price as the dividend, which is D0. Great. The dividends for X7 will be paid in the near future. And then it says dividends paid in the recent years given. Now, if you're given the dividends paid in the recent years, that only indicates that we can get a trend and with which we will be able to get the growth factor. And then it says the 5% preference shares have got a face value, that is nominal value of 0.5 per share, and an ex-dividend market price, which is 0.31 per share. Then he says long-term borrowing consists of loan notes and a bank loan, and the bank loan has got a variable interest rate. Then he says the 7% loan notes have got a nominal value $100 per loan note and a market price of 102.34 per loan note. The annual interest has just been paid and the loan notes are redeemable in a 4 years time at a 5% premium to a nominal value. So I think I know you might have done this question, but sometimes doing it together, you feel a little pressure of the examination level as well. So I think let's do it. So we'll start with the data. I'm now going to go to the Excel sheet. So we're going to solve this out. Let me zoom the Excel sheet a bit more. Okay. So I think at the first instance, let me just put this. This is my question number 1, which is on a cost of capital. I'm putting the name of the question as too far. So that later, you want me to share this Excel sheet? Maybe yes. We'll share the notes also to you. That's fine. Okay. So let's, I think, proceed with the inputs now. So I'm going to first of all calculate the cost of equity. So first we're going to organize the cost of equity. Now, can you tell me the cost of equity is going to be computed using which model? You have the question already with you. So based on the data, what do you think the cost of equity is going to be computed using which model? That's right. So we're going to use a dividend discount model. So let's, I think, first organize the data. So I'm also putting it, the way you can do it in the exams. So we'll first of all, organize the data. Now you'll say, should I put it in the exams that organize the data? Why not? So we're going to first of all organize the data. Let's organize the data. Now what all informations do we need? We need to first of all organize D1. But I think at the first instance, we are given the figure of D0. So what we can do in terms of D0, we can get the cum dividend price and reduce the ex dividend price, and then we can consider the value. So what was my cum dividend price? So what was my cum dividend price? I guess let me just take that first part again. I close that file. So my cum dividend price in this particular case, that is given to be 7.52 and 7.07. So this is 7.52 minus 7.07. So I think this works out at how much? That's 0.45, correct? So we get 0.45. So this is D0, but we need to organize D1, for which we need the growth to begin with. So since we need a D1, we need to organize the figure of growth. Now, as far as the figure of growth is concerned, so we are given the trend. So the trend is given that in the year X3, and we need to be very careful. He's giving you the dividends in a reverse order. X6, X5, X4, X3. Now tell me, the growth will be seen from which pattern? X3 to X6 or X3 to X7? When you go to identify the pattern, which pattern will you look at? That's right. We look at X3 to X7 in this particular case. So we'll go back and see the pattern. We'll study the pattern from the year X3 to the year X7. So in this particular case, if I look at the pattern, so we know the pattern is that from 0.37, it has become 0.45. So we can say it is from 0.37, it has grown to 0.45. So what do we do now in this particular case? We need to compound that 0.37 and compound it at a given growth rate so that it becomes 0.45. So what you're going to do? Press is equal to, so 0.37, can I say, and this will be into 1 point. Okay, first let's I think write down the formula only. So this will be into 1 plus the growth factor. So can I say this is going to be raised to power how many years? So 3 to 4, 4 to 5, 5 to 6, 6 to 7. Can I say how many years? 4 years. So now we can get this on the Excel sheet. Oh, I think I need to not write the formula. Let me not use equal to, let me just directly use 0.37 into 1 plus G, and this will be raised to power 4. So let's calculate this is equal to 0.37, and this will be, so I think first I need to divide this. This is equal to, sorry, this is going to be equal to 0.45. So why till X7? You see, we are given the latest year information, that is X7. So what he did intentionally in the question, if I take you back, he said dividends paid in recent years are given, but the current dividend for X7 will be paid in the near future. So you have the data from X3 till X7. So we need to consider all that data across. So I think what we can do in this case, first we can take 0.45, divide this by 0.37. Can I say this can be taken raised to power brackets 1 oblique 4. So I think this is the growth rate, I guess. Just see, is this what we're getting the growth rate? So don't we have to calculate the growth using the CAGR? Well, this is nothing but the compounded growth rate only, because when you have taken 0.37, compounded it at the rate of 1 plus G, it's a CAGR only effectively. So are we getting this? Is the growth rate coming to this? It's coming exactly 5%. Is exactly coming 5%. So why did I get it different? 0.45 raised to power. So I think let me do one thing. Let me split this up. Let me first get this figure. Then I will take this figure raised to power 4. Oh. So we'll take this figure, and this is raised to power 1 oblique 4. But why I'm getting a different figure? Brackets. Yes, and then minus 1. Yes, it is exactly 5%. You're right. It is coming to 5%. So 1.05 minus 1. It's coming 5% exactly. Wonderful. So the growth rate is organized. Then we can go and organize the figure as far as D1 is concerned. So can I say D1 is going to be D0? That is 0.45. And this will be multiplied with, can I say 1.05? That comes to D1. So I think D1 is done, growth is done. We just need the price of the share, that is P0. So which price are you going to consider in this case? Ex dividend or cum dividend quotation? Ex dividend, that is 7.07. That is the price of the share. So I think we've organized all this. I'll just maybe highlight this inputs. So I think now we have all the data with us. Can't we write down the growth rate without working? No, no, no. You need to show the workings in any case. Let the examiner know that you know how the data has been derived. Workings are very important. So don't miss out on the working notes, because if you don't do the working notes, then the marks would be deducted. So workings are very important, because as per the new marking scheme of ACCA, which has then been quite some long as well, even if you get a wrong answer, but if you show the correct workings, you will still get marks. Now let's organize the cost of equity. So the cost of equity is going to be what? Is going to be D1, that is 0.4725. So 0.4725 divided by PO, that is 7.07, and plus the G, that is 5%. So let me get the values. This is 0.4725 divided by 7.07. And this is coming to another 5%, 0.05. So I think if I solve this, this is coming to, I think it's coming to 11.68%, right? Right, it's coming to 11.68%. Okay, wonderful. So I think this gives me the data as far as the cost of equity is concerned. So the cost of equity is coming to 11.68%. Great. Now this is cost of equity done. Then we go to the next one. The next one I think we've got is the cost of preference. So the next one we've got is the cost of preference. So for cost of preference, there is no model. We directly need to calculate the data for cost of preference. So can I say we'll use the concept KP is equal to, can I say simply D by P0? So let's again organize the data. I'm just putting it as arranging the data. So let's arrange the data. In this case, if I arrange the data, let's see what is the value of D. Let's go back to the question. So I guess for the 5% preferential, what is D? It says the face value or the nominal value is 0.5 and the preference dividend is at the rate of 5%. The dividend is always paid on the face value. So can I say on 0.5, we'll take a 5%. So this will be on 0.5, we'll take a 5% dividend, that is into 0.05. That becomes the value of D. And then we consider PO. So what is the price of the share? So as far as the price of the share is concerned, we are already given the market price is 0.31. So this comes to 0.31. So you can calculate the cost of preference. So this is going to be this divided by this. So I guess this is coming to around approximately 8%. That's right. So this works out at 8%. So that is the cost of preference. Right. So the cost of equity is done. The cost of preference is done. Now tell me what is the next agenda? Can I say we need to get the cost of debt? That's right. So let's get the cost of debt. Is it redeemable or is it irredeemable in nature? I think it's redeemable if I rightly remember. So cost of debt is redeemable in nature. And if it is redeemable, can I say I need to basically calculate the internal rate of return? So let's organize the data. Let's organize the cash outflow. So we'll organize the cash outflow and we'll organize the cash inflow. So we'll do this all and then just calculate IRR from the Excel directly itself. Now, in terms of the cost of debt, I am given the information. It says that the loan notes have got a face value 100 per loan note. but the market price is given to me, it is 102.34. And the annual interest has just been paid, and they're going to be redeemable in a 4 years' time at a 5% premium. Now, the question, can you tell me what will be the cash outflow for the purpose of calculating KD? Because when you go to calculate the internal rate of return, that's right, the market price that is 102.34, that becomes the cash outflow. So let's put it as 102.34. And in terms of the cash inflow, we'll have to organize the data inflow in terms of various years. So what is the tenure of this particular instrument? It's a 4 years tenure. So we need to organize the inflows for a period of 4 years. Now tell me, the interest which you're going to consider is going to be as it is, or are you going to consider the interest net of tax? Since we are given a tax rate, the inflows will be organized based on net of tax. That's right. So let's organize the interest rate. So I am given the information. The interest is 7% on the face value. So on 100, if you take a 7% interest, it is 7. And the tax was, I think, at what rate? If I remember, it was 30%, was it? So we can organize the amount. The interest is 7 into net of tax, which was, I think, coming to 4.9. So this is going to be 4.9 in all these years. And what about the last year? What will be the inflow in the last year? Can I say we will take both the interest 4.9 and the redemption value as well? The redemption value is going to be a premium of 5%. So can I say 4.9 plus another 105? And that works out, I guess, at 109.9. Is that correct? So now we can easily calculate the internal rate of return. So you can just select this. I think let me first take this in brackets. So 102, let's take the outflow in terms of brackets to organize the internal rate of return. So we can calculate the internal rate of return. So you can select this and directly get the internal rate of return. Is it coming to 5%, I guess? So can we take a grand total instead of doing too much calculations for interest? You can, but then you see internal rate of return, you'll have to do it then on a manual basis. Because in this case, if you want to use the Excel sheet, then in that particular case, I think you need to organize the data on a yearly basis. If you do it manually, you'll have to use a hit and trial. This will get the answer faster. So see, are we getting 5% cost of debt? Yes, so 5% is the cost of debt. Great. So this gives me the cost of debt, which is redeemable debt. Now, finally, we just need to consider the cost of term loan as well. So I think there is a cost of term loan. Now, tell me what is going to be the cost of term loan. This cost of term loan is got a variable interest rate. So tell me what will be the cost of term loan. Let's go back. It says that as far as the term loan is concerned, the bank loan has got a variable interest rate. So I'm not given what is the variable interest rate. So what do we do with the term loan? You've all done this question earlier. So let's get the term loan cost from your side. So what will be the figure? 5%. Which 5%? So can I say the cost of debt and the cost of term loan will be taken equal? Yes. So we'll take 5%. That is same as, let me put this in the bracket. It is same as debt. Wonderful indeed. So I think now we are ready. Now we've got the data, and with this we can organize the information. So all these elements are done. We've taken the cost of equity, we've taken the cost of preference, we've taken the cost of debt and term loan. Now we need to calculate the WACC. That is supposed to be weighted average cost of capital. So in terms of weighted average cost of capital using a market value weights. So using a market value weights, we just organize the data. Now there is a quick way with which you can, always get correct information. So I think I'm just going to organize the inputs to calculate WACC. First, you create a column for particulars. And then you can consider that what is the face value of these securities given in the question. Then you can divide it by the nominal value. And then you can get the number. Then you can multiply with the market value. And then you can get the, so you can get the market price. And then you can get the total market value. And then you can convert this into weights. Then you can convert this in terms of weights. Sir, is this IRR formula will be there in the exams or not? Yes, it will be there in the exams. You can directly apply the Excel and get this. And then we have the cost of each source. Then we'll get the WACC. So this will be the easy format to do this. You can always use this as a set format. Take a column for the name of the security. Then take the face value, divide it by the face value, get the number. Multiply with the market value to get the market values converted into weights. Now, let's, I think, pick up the data from the first part of the question. I guess we are given the share capital comprising of ordinary shares and the preference shares. So let's take the ordinary shares. Let's take the ordinary shares. Let's take the preference shares. And then we'll take the debt. And then we'll also take the bank loan, the term loan. So let's pick up the values from the question itself. So I guess the share capital is 12 million ordinary share. So 12 million, let's take this as a wholesome number. Or maybe you can take this in terms of thousands. So 12 million would mean how much in terms of lakhs? In terms of thousands, I guess, is it 12,000? So if I take this in terms of thousands, this is coming to 12,000. That's right. So we'll take the figures in terms of thousands. This is in terms of thousands. Okay. So this is as far as the value of equity is concerned. Now let's get to the millions, slight easy. You can take millions also, that's not a problem. And then next I am given, the next input which is given is the preference share. Preference share is 5 million. So I think that works out at 5,000. Then let's consider what is the value of debt. So I guess in terms of value of debt, so that breakup is given in the next page. So it says the long-term borrowings is consisting of loan notes and bank loans. So 10 million, 10,000, 3,000. So this is 10,000 and this is 3,000. Right. So this is the total face value which is given. So ordinary share has got a face value how much? What is the face value of the ordinary shares? I guess the face value of the ordinary share has got 0.5. So this is 0.5. So what will be the number? I guess 24,000. And what is the face value of the preference shares? Face value of the preference share is also 0.5. So this is also 0.5. So can I say this will become 10,000? This is the number which we are calculating. And as far as debt is concerned, so what is the face value of the debt? Debt, I guess, is $100. So this is 100. So this will come to what? I guess 100. And this would remain 3,000. I mean, this is not, the face value itself is 3,000. So this doesn't have a number. So I'll put it blank. Okay, so this gets a market value 3,000 only. So this market value remains 3,000. Bank loan, the market value would remain the same. Now let's see what is the market price of the shares. What is the market price of the shares? So market price of the equity share is 7.07. So 7.07. So we can get the market value this into this. And what is the market price of the preference shares? The market price of preference share is 0.31. So this is going to be 10,000 into 0.31. And similarly, as far as debt is concerned, what is the market value of the debt? That's, I think, to the extent of 102.34. So this is 102.34. So we can multiply this into this. That's the market value. So I think now we can get the market values, sum total. So this gives me the market value as a total. Okay, now once you've got the market value, we can convert this in terms of weights. So to convert this in terms of weight, we need everything to the base of 1. So what I'll do to convert this to the base of 1, you can take this upon the total. Isn't this coming 186? Yes. So I think this is the weight. Then you consider this divided by the total, and you get the weights for each one of them. So this is how we get the weights for each one of them. And we can just make a check, if this is coming to 1 as well. Just let's see the total. Is the weight coming to 1 approximately? Yes, it is. Perfect. Okay, now tell me what was the cost of each source? What was the cost of ordinary shares? So what was the cost of ordinary share? 11.68. So 1168. This is 0.1168. What is the cost of preference shares? That was 8%, 0.08. And what was the cost of debt? 0.05. And this is also 0.05. So we can now just multiply this. So we can stretch this. We get the figures. So we can add this up. So this will give us the total cost. I think it's coming to 11.14%, I guess. So that is the weighted average cost of capital. So this is 11 marks. Wonderful indeed. So I think that's great. After the competition, it becomes purely mathematical in nature. Wonderful. So this is how the calculation of the WACC is done. You want me to do one more question on cost of capital, or we switch the chapter? So what do you want? Something similar, more on the cost of capital, or we switch the chapter and go to the next area? Switch the chapter. Okay, I think everybody's switched the chapter. Okay, then let's give you something different. So let's see if this one more question. I think somebody's saying, okay, maybe we'll do one more question in the end if the time permits. Let's, I think, go to the next one. Let me now share another question to you. Maybe you've done this question as well. Some hints of the answer are already there in this. I'll just share that. This is a little blend of a lot of inputs. Just give me a second. So I'm sharing the question to you on the screen also, and I'll just share this on the chat box as well. Here goes the question. So I've shared it in the chat box. Let's now read further. All right. So let me now also share the question on the screen to you. So a few answers already given. So have you done this question earlier as well? Sir, my format, particulars, cost of capital, market value, is this enough? I got the same answer. That's fine. That's fine. I'm just showing more workings. You can do it like this also. So have you done this question? Look at this question, done this question also. Oh my God. Then what am I supposed to do? If all the questions are done, we are just doing questions what you've done. Anybody else done this question earlier? I don't see much people saying yes. No, no. Good, good. Can you give us a little time to look at the previous questions? Yes, you can just spend time. You can just have a look. I think majority has not done this question earlier. Very good. I'll just zoom this across first of all. Okay, I will share you another input out here. Let me now read the question to you. Previous answer. Okay, you want to see the answer on the Excel? Sure. What did we do in the end to find the WACC? We multiplied the cost with the weights. The weights and the cost is multiplied and you get a WACC in that case. And then I just took the sum total of that. That gives us you the WACC. Right, ready? Are we ready to go to the next one now? So I think first let's make some quick revisions on the area. So as we decided, we'll go to first make some quick revisions with you. So I am going to first make some quick revisions on the concept. So we are going to first of all discuss inputs about working capital management. So when I'm looking at working capital management, we've got various elements of working capital management. So let's begin with first of all, the first one, that is inventory. So for inventory management, the basic inputs, what you get in the exams is the calculation of EOQ. So how do you calculate an EOQ? Can I say the economic order quantity is supposed to be computed as we take the under root of 2 into annual demand. Can I say into ordering cost divided by C, the whole under root? Correct. So I think I'll raise it to the power of. So we need the whole under root. So I'll just put it as raise it to the power that is supposed to be under root. So 1 by 2. Let's put it like this. Now, key inputs to put across to you in this case. Tell me, when you consider A, that is supposed to be annual demand. Annual demand of what? Is it annual demand of the finished goods or is it annual demand of the raw material? So when you're calculating the economic order quantity, we need to consider the annual demand of the raw material in this case. That's right. And when you consider O, can I say O is supposed to be the ordering cost per order? It is supposed to be ordering cost per order. Now, if you want to calculate the total ordering cost, if you want to calculate the total ordering cost, can you tell me in terms of total ordering cost, we need to calculate number of orders. We need to calculate the number of orders multiplied with O. Now tell me, how do you calculate the number of orders? So it would be number of orders into O. So how would you calculate the number of orders in this case? So number of orders is going to be what? That's right. The number of orders is going to be the annual demand, and that's going to be divided by the EOQ. So that's how you're going to get the number of orders. Now, quick insight. Can the number of orders be in decimals? And if it is in decimals, do we need to round it off or do we keep it as it is? If you're getting the number of orders in terms of decimal, so do we round it off? No, we will not round it off. So if it is in decimal, no rounding off. So please remember that in this case, rounding off will not be done in this case. Yes, because the benefits will be received in the future. I could see, some students saying that, yes, we will round it off, we will not. Though we will, order the wholesome number, but the benefit of that extra order will be attained in the next year. So no rounding off to be done. Similarly, when you're calculating C is supposed to be carrying cost. That is per unit per annum. So it is carrying cost per unit per annum. Now, when you are going to calculate the total carrying cost, please tell me how are you going to calculate the total carrying cost? Now, when you're calculating the total carrying cost, also remember the total carrying cost is supposed to also include any buffer inventory as well. So can I say in this particular case, you will take the buffer inventory and then take half of EOQ. So I will take the buffer inventory. I will take the buffer inventory and also add half of EOQ as well. So we need to be careful because generally what we are in a habit to do is that for the carrying cost, we take half of the EOQ and then get the answer. But you need to consider the buffer inventory plus half of EOQ, and then it is to be multiplied with C. Then it is going to be multiplied with C. That's right. So take the buffer inventory, if any. So I think let's better put it like this, that I would say buffer inventory, if any. So if there is any buffer inventory and then you take the half of EOQ into C, we get the results on that. Okay. So this is as far as economic order quantity is concerned. That's the main crucial point in terms of inventory. Now let's, I think, go to the receivables management. Now let's go to the receivables management. So we'll quickly revise the concept in terms of receivables management. Now, in receivables management, typically what you get is that there is, either a change in the credit period. Mainly, you can get questions which are based on factoring. Now, I don't know whether I should typically make a revisions of all the three kind of situations, or we just talk in terms of factoring with a financing arrangement, or you want me to discuss financing, you want me to discuss just administration, combined everything. Let's, I think, take two cases. So a revision on discount as well. Okay, if you want the revision on discount, then okay, let's give you the discount part as well. When you look at the discount part, what you need to do first of all, step number one, you need to first of all calculate the effective discount. You need to first of all calculate the effective discount in percentage. How do you calculate an effective discount? Can I say if the discount is, let's say, 2%, so what are you going to do? Are you going to say the discount is 2% or 2 by 98? Yes, we are revising the discount as well. No worries. We are revising the discount. So let's say if the discount is at the rate of 2%, so the effective discount is going to be 2 by 98 into 100. You get the effective discount percentage. Great. Then you go to the step number 2. And then you need to find out the frequency. You need to find out the frequency in this case. And whatever is the effective rate. So I'll take 1 plus the effective rate which you have computed in step number 2. So can I say this will be raised to power the frequency? This will be raised to power the frequency, and you will get the annual. You will get the annual effective rate. So you will get the annual effective rate in this case. And then what do you do in terms of step number 3? Maybe you can keep this, frequency as the step number 2, and you can keep this as step 3. So you can get the annual effective rate. So this is what you do in the discount rate calculations, that you need to first of all consider effective discount, and then you need to calculate the frequency so that you can calculate the annual effective rate. Then you compare the annual effective rate. Then you compare the annual rate with interest rate. So then you compare the amount of annual rate with the interest rate. Now tell me if the annual rate is more. If the annual rate is greater, then what? And if the annual rate is less, then what? So if the annual rate is more than the interest rate, then will you avail a discount? Your effective annual rate comes more than the interest rate. So in this case, will you avail the discount? Yes. So your annual rate is coming more and the interest rate is supposed to be less. You're talking of a debtor giving you money. So if your annual discount is more, that means you'll give more discount to the customer. And you will say, I'll take a loan instead. Are you sure that if the annual rate is greater, you will give the discount? No, the discount is not given in that case. We don't avail the discount. This is not a case of payables, it's a case of receivables. In this case, if the annual rate is greater, that means it is costing me more. If I want liquidity, it's better I'll borrow money from outside rather than giving a discount to the customer. Okay, so this is on the receivables part. This is on the receivables part. Now let's go to the next one. Now we want to quickly make some revisions on the concept of factoring. So factoring, where we are considering that he is going to help you, factoring where he's going to help you in admin as well as he's going to finance you. So what do we do in this particular case? Can I say a cost benefit analysis? So give me the list of benefits which I will get and give me the list of cost which I will incur. So if I'm engaging a factoring agency, start telling me what are the benefits which I will get. Can I say probably one of the most common benefits would be what? So if I'm going to engage a factoring agency, so what would be the main advantage I will mostly get? Saving in administration cost. I thought I'm going to get shoot answers. Saving in the administration cost, and tell me more advantages which might be there. If he reduces your debt collection period, then what? If debt collection period reduces, if the debt collection period in this case reduces, then what? Can I say there will be an opportunity gain? That's right. We're going to get the opportunity gain. The cost will be saved. And in terms of the administration, in terms of cost, what further cost will be there? If you engage a factor, can I say you're going to pay interest? You're going to pay interest on the loan. So rather, let's take the fees, pay the fees to him and the commissions. So fees and the commissions will be paid. And anything else? You pay the fees and the commission. Anything else? Can I say you're going to pay the interest? You're going to pay the interest on the loan taken. So whatever loan is taken, finance is taken, you're going to take that as well. So basically a cost benefit analysis will be done. Tax is generally not given in this kind of question. So I think tax would not come into play. So I think it's mainly to do with the fees and the administration cost and the opportunity gain if the debt collection period reduces and the interest. Reduce risk if there is a non-recourse factoring, that would be non-financial factors, I would say, not financial. So here the cost benefit analysis is going to be purely on the basis of, you can say, financial factors. Okay, so I think we have just taken a very quick look in terms of inventory, in terms of receivables, and in terms of the discount policies for inventory. I think now let's start doing a question with you. Bad debts, yes, there can be a saving of bad debts. So I think you can put the benefits out here. There will be saving of bad debts. That is also one of the inputs. Correct, absolutely. Okay, now I think we're ready to go to a question. In this question, which I've shared with you, there is a concept of Forex as well. So please give a revision on the early settlement discount. We just did that. This is the part which we did. You want a question? You want me to do a question on this part? Theoretically, we have done a revision that you get the effective discount that is in percentage, then you get the frequency, and then you get the effective rate compared with the interest rate. You mean a practical illustration? When the percentage of customers are given, okay, I got the point. Though I have not selected that question right now because I've selected some examination questions. Those questions are more in section A and B. Maybe we can handle that in the doubt session, or maybe I can take it up. But maybe first we'll start with this question. Okay, so I think let's begin a journey on this particular question. So I think most of you have not done this question. So I'm going to the first requirement of the question. It's a 20-marker question. 6 marks. Bad debt depends upon the factor with the recourse and non-recourse. Yes. Because if it is going to be a non-recourse or a recourse arrangement, accordingly the bad debts will be saved. That instructions will be, of course, very clearly stated in the question. Okay, now there are 3 requirements in the question. The first one is dealing with the inventory management. Second one is a theoretical one. And the third one is supposed to be dealing with Forex. So, though we made a revisions in terms of working capital, but what do you want me to do? Do you want me to do the Forex question first? No. First, I think we should do the inventory one. Then we'll come to the Forex one also. This was one of the past examination questions where Forex has been asked in terms of section C. Now let's read the input. It says PKA company is a European company that sells goods solely within Europe. The recently appointed financial manager of PKA has been investigating the working capital management of the company and has gathered the following information. Now, look at this very carefully. The current policy is to order 1 lakh units when the inventory level falls to 35,000 units. Now, analyze this carefully. It says the current policy is to order 1 lakh units when the inventory level falls to 35,000 units. And then it says the forecasted demand to meet the production requirement during the current year is 6,25,000 units. Can you tell me what is, okay, too early. I think let's first go further. Then he says the cost of placing and processing the order is given, that's O. And the cost of holding a unit in the stores is 0.5 per unit, that is C. Both the costs are expected to be constant during the next year. Orders are received 2 weeks after being placed with the supplier. You should assume a 50-week period and demand is constant throughout the year. Now, my quick question to you. Number one, can you tell me what is the buffer inventory? Look at the data carefully and give me the buffer inventory. It is supposed to be 10,000. Okay. Though I think I've also written the answer. So that could also be a catch. So I think I got one answer on the buffer inventory. So please calculate what is the buffer inventory. Company has got a policy to order 1 lakh units when the inventory level falls to a total of 35,000 units. And it says that my lead time, the orders are received in 2 weeks. My lead time is supposed to be 2 weeks. So I think I got very few answers on the buffer inventory. I think let me work this out for you. So this is question number 2. That's right. Now I'm getting good answers on that. That's right. So this is my question number 2. That is on inventory and that is on Forex. So on the inventory and on the Forex part. That's right. I think now we got the correct answer. It is 10,000. Let's begin. So first of all, I am given that the company orders 35,000 units. So the company, in this case, it says it orders it orders 1 lakh units. So it orders a total of 1 lakh units. So we order 1 lakh units when inventory falls. When the inventory falls below 35,000, when it falls to 35,000 units, we order the inventory. Now I'm also given the input regarding the lead time. The lead time is given to me, it is 2 weeks. So I'm also given more data. I'm also given the annual demand, and the annual demand I think is 6,25,000. And this annual demand is supposed to be for 50 weeks. Now, a simple and a straightforward question. If your annual demand is 6,25,000 for 50 weeks, can you tell me what is the demand per week? What is the demand per week? Can I see we can divide this 6,25,000 divided by 50 weeks, and we will be able to get what is the demand per week. So this comes to 6,25,000 divided by 50. It comes to 12,500 per week. So this is, you can say, the demand per week. Let us also calculate the demand for lead time. So what is the demand during the lead time? So can I say 12,500 per week, and the lead time is supposed to be 2 weeks. So can I say the total demand during lead time is 25,000 units. Now think of this, you'll get the results. Can I say the company orders 35,000 units And when it orders, no, we can't take 52 weeks. The instruction is very clear in the question that we need to consider, it says a 50-week year. Assume it's a 50-week year, so we'll have to keep it at 50 only. Now, in this particular case, we are very clearly instructed that, we order 35,000 units every time the inventory falls up to, when the inventory falls to 1 lakh units, we order this. So we order a total of 1 lakh units when the inventory falls. Sorry, I think I missed out something. The current policy is to order 1 lakh units when the inventory level falls to 35. So when the inventory level falls to 35. Now, which means when you order the inventory, you order 35. So by the time the next order will come, can I say you utilize 25,000? So 35,000 units is the level at which you order. By the time the inventory order comes, 25,000 units will get consumed. So can I say this difference 10,000 units becomes the buffer inventory. So I think this is the crucial point in the question, that the buffer inventory is to be computed in this case. Right? I hope you got the inputs, that since the lead time would mean 25,000 units will be consumed. So if you've got 35,000 units in stock, so by the time the inventory, comes, you can say 25,000 units will get consumed. So you'll be left with 10,000 units at that time. That is the buffer inventory, which remains in godown forever, which remains in inventory every time, or let's put it as forever. So that is important, because without this buffer inventory, we will not be able to make the carrying cost calculations, because we need to consider the buffer inventory as well. Now let's come back to the question. So what is the requirement in point number A? Calculate the cost of current ordering policy and determine the saving that could be made by using an economic order quantity. Now the question is asking you that if you follow the current policy vis-a-vis if you follow the concept of economic order quantity, what is the difference? So let's first organize the EOQ. So we're going to first of all calculate the economic order quantity. So can I say we have the data? Let's organize the data. So for the calculation of EOQ, we are arranging the data. So as far as the data is concerned, we've got the annual demand. So what was my annual demand? I guess 6,25,000. Then let us see what is the ordering cost. So what is my ordering cost in this case? I think it's 250. So the ordering cost is supposed to be 250 per order. And then we are also given the carrying cost, that is C. What is the carrying cost? I think it's 0.5 per unit per annum. I think that's it. We can calculate the economic order quantity. So let's take this as 2 into annual demand 6,25,000 and into ordering cost is 250 divided by the carrying cost, that is 0.5. We need to take the under root as well. So now we will take this value and this will be raised to power 1 by 2. Is this the inventory coming or some calculation error? 2 into annual demand into 250 divided by 0.5. Yes, I think that's it. And we take the under root. So is this correct? I don't think so. Just check the calculations. Brackets. Yes, forgot to put the brackets. Right, so brackets done. So this becomes my economic order quantity in this case. Right, 25,000 is my EOQ. Now with this, we can make the comparative chart. So let's make a comparative chart, particulars, and we'll take the existing policy. There is an existing policy and we've got the EOQ policy. So on this basis, okay, now tell me, do you need to compare the three costs or do you need to compare just the ordering and carrying cost? There is no discount which is given in the question. So can I say if there is no discount which is stated in the question, then can I say we just need to compare the ordering and carrying cost? Correct. So let's take the ordering cost. Let's consider the ordering cost and the carrying cost. So this is the ordering and the carrying cost. Now let's go to the existing policy. In terms of existing policy, let's see what is the ordering cost. So how many number of orders will there be? Can I say it is going to be 6,25,000? And every time we are ordering, I guess 1 lakh units. So can I say 6.25 orders? So you can calculate the ordering cost. This is going to be 6.25. Keep it in decimals. And what is the ordering cost? 250 per order. So this comes to how much? 6.25 into 250. That's, I think, around 1563 approximately. Okay, now let's calculate the carrying cost. You help me, what will be the carrying cost? So in terms of carrying cost, we will consider just half of EOQ or something else as well. So in terms of carrying cost, simply half of EOQ or yes, including the buffer inventory. So my buffer inventory is 10,000 plus half of EOQ. So what was my EOQ? Sorry, existing policy is ordering 1 lakh units. So this is going to be a total of, I guess, how many units? 60,000. So this is, I guess, 60,000 units into 0.5. And I think that works out at 30,000. So this works out at 30,000. So we can get the sum total of the cost. So this is coming to 31,563. This is my existing ordering and the carrying cost which is there. Now let's come to the economic order quantity. So in terms of economic order quantity, give me the number of orders. 6,25,000. Achha, sorry, I got the wrong orders. Sorry. I mixed up the EOQ. This is not 6. No, this was correct. Sorry. This was correct. So now we need EOQ. EOQ will be 6,25,000. And what is the order size? 25,000, right? We are ordering 25,000 each time. So there is going to be 25 orders into what is the ordering cost? 250 per order. So 250 into 25, that's, I think, 6250 is the ordering cost. Okay, now let's consider what is the carrying cost. So we'll take the buffer inventory, that is 10,000 plus half of EOQ, and the EOQ is supposed to be 25,000. So let's see what is the average inventory. So this is going to be 22,500 and this is 0.5. So 22,500 into 0.5, this is, I guess, 11,250. Right. So let's see what is the total of the ordering and carrying cost. I think it is 17,500. So this gives me the total ordering and carrying cost for EOQ. So can I say, as compared to the existing policy, the company has saved money. So what is the savings? So we take the difference, 31,563 versus 17,500. It comes to 14,063. So that is the amount of savings which are there. Right. So I think this answers the first requirement of the question. That is, what is the amount of savings as compared to the existing and the EOQ? Okay, now we need to do the question of Forex. So you want me to first give you a break before Forex or do the question of Forex? Because it has got money market hedge. It has got forward contracts. So you want me to first take a break because I think people are getting tired. That's what the feel I'm getting. So you want me to first give you a break? You want me to first give you a break and then start back and do some more questions? No message, just one person saying break. Rest, I think, what do you say? You want to break at this stage? I think let's get the minds fresh. Okay, so I think let's give you a break first and then I think we'll start with the process of Forex question. Then we'll do some more questions with you. So I think 10-12 minutes. I join you back in another 10-12 minutes time. Enjoy your break. Welcome. I guess we're ready to begin back. So, first, I think we'll take a little quick look at the concept of Forex. Then we'll do a question on this part. So, let me share the board to you. So, first, we'll, I think, just quickly revise the concept as far as Forex is concerned. So, I'm looking at things in terms of a forward contract. So, in terms of a forward contract, in terms of forward, can I say, does it make a difference whether you're importer or exporter? And that's right, it doesn't make a difference whether you're importer or exporter because we just need to apply a forward exchange rate. That's it. So we just need to apply the exchange rate and get the results. So I would say that when you're looking at the concept of a forward contract, irrespective whether you are an importer or you are an exporter, we need to basically apply a rate of exchange. So I always said that there are two things you need to understand, that do we divide or do we multiply? And the second rule, tell me what is that? Because you're going to first of all decide that do we divide or multiply in what way. So what is the thumb rule we need to keep in mind as far as Forex is concerned? That you always pay what and always you get what? Pay more and you should always get less. That's wonderful indeed. So this is what we're going to apply in terms of Forex. So when it is a importer, exporter, doesn't make a difference. Just decide, multiply, divide, and then just multiply, divide in such a way that you pay more and get less. Now let's come to the concept of a money market hedge. So is this position in a money market hedge remain the same for importer, exporter, or is it going to be different for importer, exporter? Unlike a forward contract, so is the position going to be same or is it going to be different for importer exporter? Different. So we will consider the importer and we will consider the exporter. So I think let's first make a walkthrough in terms of importer. I'll keep asking you the inputs and you can decide. Number one, as an importer, you have an obligation to pay. So what am I supposed to do today? Create an asset or a liability? In the future, I have an obligation to pay. So I have a liability which is there in the future. So what do I do today? I should create an asset. I know some of the students who might be not studied from me must be wondering, what is going on. So once we do the question, we'll see, what is your strategy, but we do it like this. So in this particular case, we will create an asset. Now tell me, when you're going to create an asset, what is the value at which the asset will be created? Can I say the value of the asset will be created equal to the present value of future cash outflow? Correct. So we need to consider the amount of asset equal to the present value of the future cash outflow. And for this, which discount rate will you consider? So when you're going to consider the present value, the discount rate will be which one? Deposit rate or borrowing rate? And that's right, we're going to consider a deposit rate in this case to calculate the present value of this information. Wonderful. Now, coming to the second step, once you've decided that what is the present value of future cash outflow, then what do you need to do? You need to convert this at what rate? You need to convert this at what rate? Can I say at a spot rate? So we're going to convert this at a spot rate itself. And then finally, in terms of the step number 3, you need to calculate what is the total cash outflow for the importer. So can I say this is the amount in step number 2? And to this, we will add the interest. And this interest will be which rate? Borrowing rate, or is it going to be deposit rate? So that's right. We're going to consider a borrowing rate for this particular purpose. So this will give us the answer for importer. Now, similarly, if I apply the concept of exporter, so in the future, he is going to get an asset. In the future, if he's going to get an asset, so today what should I do? Create a liability or create an asset? So we need to create a liability in this particular case, and the liability is going to be equal to what? It is going to be equal to the present value of future cash inflow. So we will take the present value of the future cash inflow, and using which discount rate? Deposit rate or the borrowing rate? So we will consider the borrowing rate in this particular case. Wonderful. And then we go to the step number 2. Now in step number 2, this present value is going to be converted again at a spot rate. So we will convert this again at a spot rate. And then tell me, what is the total cash inflow? Can I say the total cash inflow for the exporter is the amount in step number 2 and plus the interest? And plus the interest, and which interest rate will you take? Borrowing rate or a deposit rate in this case? That's right. We're going to consider a deposit rate in this case. So this is how the money market hedge is applied for importer and exporter. So forward I gave you, money market hedge I gave you. Then there is a leading concept in this case that I think will directly tackle in the question itself. So let me now share the question back to you. Now, this is the third requirement we're doing. Evaluate whether money market hedge or a forward market hedge or a lead payment should be used for a foreign currency accounts payable. So this is the information about the accounts payable. It says PK company used a foreign supplier for the first time and must pay $250,000 to the supplier in 6 months' time. The financial management manager is concerned about the cost of these supplies may rise in euro terms, and he decided to hedge the currency risk of this accounts payable. The following information is provided with the bank. You're given a spot rate with a bid and ask, and you're given a 6 months forward rate with a bid and ask. And we're also given the borrowing rates and the deposit rates in terms of euro and in terms of dollars. Assume that it is now 1st December and the company has got no surplus cash at the present time. Okay, so I think let's begin a journey in terms of a forward contract. So we are importer or we are exporter. So we've got a payable to the supplier. So are we importer or are we exporter in the given situation? That's right, we are an importer. So I think let's begin the first part of this question. So in this case, we are an importer. So let me organize the data. So we are an importer. So I want to first of all apply the concept of forward contract. So in terms of the forward contract, we will simply now decide whether we multiply or we divide. So let's first of all consider we need to pay $250,000. Now it says 1 euro is these many dollars. So $250,000 is going to be how many euro? Are you going to divide or are you going to multiply? So it says that $250,000. So 1 euro is these many dollars. So these many dollars will be how much? We'll divide. So we'll divide it in such a way that we'll land up paying more money. So tell me, which rate will you divide? 1.975 or will you divide by 1.983? Because we need to get a larger answer. Being an importer, we should get a larger outflow. So divided by the lesser figure, that is 1.975. Great. So we can say in this case, the amount to be paid is 2,50,000. And we got to divide this by 1.975. So we will get the results. This divided by the rate. So this is the amount which is outflow. This is on the forward contract. Now, next come to the money market hedge. The next one is the money market hedge. So as far as the money market hedge is concerned, I am an importer. Now, since I am an importer, so what do I need to do in this particular case? Step number 1. We need to first of all create what? Asset or liability? We need to create an asset which is equal to present value, which is equal to the present value of future cash outflow. So present value of the future cash outflow is what we'll calculate. So my future outflow is supposed to be 2,50,000. And now very carefully, when is this amount due to be paid? Can I say this amount is due to be paid in 6 months time? So when you want to discount, so tell me what is the rate at which discounting will take place? Of course, a deposit rate. So tell me what is the rate at which discounting will happen? We need to pay this money in dollars. So we know that the dollar deposit rate is 3.5. So what do I consider? Do I consider 3.5 or we make it pro rata? That's right. We convert this on a pro rata basis. So we can say the rate of interest is supposed to be 3.5% per annum. So we need to convert this pro rata 1.75% for 6 months. So we convert this for a period of 6 months. So let's calculate the present value of this. So we need to discount this 1 divided by 1.0175. So this is going to be 1 divided by 1.075, and this is the factor raised to power 1. Right, so we can get the present value. So let me identify what is the present value. So the present value in this case is going to be 2,50,000 into the discounting, and that's I think 232. Just see if this answer is correct. This is the present value 232,558. This is the present value of the future outflows. Is that correct? Discounting factor is incorrect. Okay, so what is the discounting factor? It is 1.000175. Okay, now see, is this correct? 247, 245, 700 is the present value, I guess. Great. Then we go to the step number 2. And in terms of step number 2, now what we need to do, we need to basically convert this money at a spot rate. Convert it into spot rate. Say if I take the money in spot rate, so this is 245, 700 approximately. And what is the spot rate we're going to use in this case? So we have this answer. By the way, this is in dollars or is this in pound? Sorry, euro or this? This is in dollars or this is in euro? So when you have taken the present value, can I say this is of course in terms of dollars? So we need to convert this in terms of euros. So now do we divide or do we multiply? It says 1 euro, these many dollars. So these many dollars, how many euro? We need to divide or multiply? No, not multiply. We need to divide in this case and divide it in such a way that the answer should be more or the answer should be less. So we should get more answer divided by 1.975. Sorry, spot rate is 1.996. So we're going to divide this by 1.996. So let's divide this by the spot rate. And I think this is correct. This is coming in euros, I guess. This is what we get in terms of euros. C is the answer correct? Yes. So this is the amount which has to be borrowed in terms of euros. Then we go to the step number 3. Then we need to go to the step number 3. And in step number 3, we need to get the total cash outflow as an importer. So if you want the total cash outflow as an importer, so we will multiply, add the interest in this case. So this is going to be 123,096. And let's take the interest. So tell me the interest rate to be taken. So now I'm given the borrowing rate in terms of euro. It is 6.1. So do we take 6.1 or do we convert this pro rata? That is 3.05%. Correct. So we know the interest rate is 6.1% borrowing rate, but we need to convert this on a pro rata basis, 3.05%. This is for 6 months. So let's add the interest on this. So I can take this amount into 1.0305. Okay, can you explain the pro rata figure? You see, the 6.1% interest is supposed to be a per annum rate. If you look at the data in the question, 6.1% is supposed to be the annual interest rate for 1 year. But all these calculations are being done for a period of 6 months. So you need to divide it by 2 to convert it to 6 months. That comes to 3.05%. Right. So this is the final answer, which is the outflow. I hope the answer is correct in this case. You're welcome. Okay, so this is done. This was the calculations as far as the money market hedge is concerned. Then now he's also asking another input as well. It says evaluate the money market hedge, done, forward market done. Then it says lead payment. Now the third option is that we make a lead payment. Lead payment means what? That we pay right now. That we pay right now. So we are going to pay this money right now using a spot rate. So in this particular case, let's see what is the total cash outflow. So if you're going to pay right now, so let me apply the spot rate in this case. So let's get back to the question. So what is my spot rate in this case? So what do we do? Divide or multiply? So we are an importer. We are going to pay money. So pay more. So divide by what? 1.996. So this comes to 2,50,000. And this is going to be divided by 1.996. So this is going to be this divided by this. It comes to 125. Anything else to be done to this as well? So we have taken 125 to 50. Is there anything else which also needs to be incorporated? Compounded. So can I say this is the payment made right now? There is an opportunity cost as well. So we need to add the interest for the period of 6 months as well. At which rate will you add the interest rate? So can I say the interest rate will be added at which rate? The interest rate on the borrowing rate, and the borrowing rate for the purpose of dollars is supposed to be what? Can I say it is supposed to be 4%? So we'll take what? The borrowing rate is given to us, it is 4% per annum. So we're going to again convert this 2% for a period of 6 months. So we need to add the opportunity cost in terms of interest for a period of 6 months. So let's add a 6%, a 6 months interest. So we take this figure into 1.02. So this is the total outflow. Now you can see which is the best option available. So let's see what is the best option available in this case. Can I say wherever the outflow is the least? I guess in terms of forward contract, it was 126,582. Then it is 126,850. I think the least outflow best option is in terms of forward contract, I guess. Yes, the forward contract is the least outflow. It is 126,850 and this is 126,580. Yes, forward is the least one. Okay, please explain the opportunity cost part again. Okay. Now, you see, the company does not have any surplus money. There is an instruction given in the question. Assume the company has got no surplus money as of now. Now, if you've got no surplus money as of now, that means you are going to pay the money right now. And if you're going to pay the money right now, you will borrow the money and pay the money. So leading the payment means that you will take a borrowing and then make a payment. So whatever money was converted at a spot rate, there is an opportunity cost of borrowing it for a period of 6 months. So 2% interest has been added. Correct. Right, so this is done. I think this question is done. Now let's go to the next question with you. So I think so far we have done questions based on inventory, based on forex, based on cost of capital. Let's take a little blended question further. Let's see the next one also you've done it earlier or not. Let's see. So maybe, I don't think so. You might have done this question. Let me, I think, share the inputs to you. Just a second. Let me share the question. Though the workings are slightly done. So this is a simple question for marker. I shared the question on the chat box as well. Here goes the question. See and tell me, have you done this question earlier? This one can't be a yes, I guess. No, very good. At least there is something, which nobody has done now. Now that makes good sense. Wonderful. Okay. So I'm just going to read the first part of the question because there are different elements in the question. I've just showed the first requirement of the question for 4 marks. So we'll just read the first para. Okay, you've done it. I think some people have done it. Anchal, Kaushik. Wow, wonderful. So I think now, because in earlier questions, I think Forex, you might have found my strategy quite different as compared to what you might have done. I can understand, because Forex is something, people do it with different kind of strategies. So my strategy may not have matched with your kind of strategy, I believe. Okay, let's read. It says, N company has got a credit sale of 45 million per annum. And on an average, it settles the accounts with a trade payable after 60 days. One of the suppliers offered the company an early settlement discount of 0.5% for payment within 30 days. Administration cost will increase by 500 if the early settlement discount is taken. N buys the components worth 1.5 million per annum from the supplier. We're just reading the first paragraph. Now look at the requirement. It says evaluate whether N should accept an early settlement discount offered by the supplier. Is this evaluation of a discount policy to the customer, or is this evaluation of a discount policy which you're getting from a supplier? I think that is one focus point which should be clear. So we need to see the early settlement discount offered by the supplier. So we're looking at a customer. We are giving a discount to customer, or my supplier is giving me a discount. I think the requirement is very clear. The supplier is giving me a discount. No, we are not giving discount. We are getting discount. In this case, it says N should accept the early settlement discount offered by the supplier. So this is a supplier's discount. Now let's look at the data very carefully. You help me in terms of cost benefit analysis. It says N company has got a credit sale. Is this relevant information or irrelevant information? It says the company has got a credit sale of 45 million per annum. Is this relevant information or irrelevant information? This is absolutely irrelevant because my focus is in terms of only the creditor. So I'm not concerned. This is completely irrelevant. Then he says the average they settle their accounts with a trade payable 60 days. So that is the credit period of your supplier. Now, one of these supplier is telling you that you give me an early money, I'll give you a discount of 0.5% if you pay me in 30 days. Now, quick input. Can I say the credit period from 60 days will come to 30 days? So can I say that means your creditors will undergo a change? If the creditors will undergo a change, there will be a calculation of opportunity cost on the same, right? Because your credit period changes from 60 to 30 days. So basically, in this case, you are paying faster. So if you're paying faster, can I say this would mean an opportunity cost involvement? Then there is an administration cost which is increasing by 500. And then it says if early settlement discount is taken, this is the saving. And we are buying 1.5 million per annum from the supplier. Now let's organize the data. So let me just come back on this. So this is my question number 3. This is on the concept of payables management. This is on the concept of payables management, quite similar to what we do in receivables management, but this is technically a payables management case. Okay, so let's do the cost benefit analysis. I think before this, let's first make a working note. So let's make a working note for the calculation of opportunity cost due to change in change in the credit period. So we'll first make a working note to make the calculations of the opportunity cost. So let's take a column particulars. Let's take the existing policy and let's take the proposed policy. So let's take the existing and let's take the proposed policy in this case. Okay. So first of all, I guess my amount of purchases, the credit purchases is how much? So I am given the information on the credit purchase. So I guess my credit purchases is to the extent of how much? From this supplier, you're buying 1.5 million. So 1.5 million would mean how much in terms of lakhs? So 1.5 million, that would mean, I guess, 15 lakhs. So this is 15 lakhs. And even under the proposed policy, the purchase will not undergo a change. Can I say that amount would remain the same? And let's see what is the credit period. So the credit period, I guess earlier was 60 days. Now it has come to 30 days. So that is the credit period. Now what should I do? First of all, tell me. I've just organized the credit purchase and the credit period. So what should I do at the first instance? With the credit purchase and the credit period, should I organize my creditors? That's right, calculate the payables. So is the information of days given in the question? So am I given that how many days we are considering? No, so I think let's take 360 days. Is given 360 days. So yes, we are given 360 days in a year. So let's take 360 days. So we will get 15 lakhs is for 360 days. This divided by 360 days into, can I say what is for 60 days? That's 2 lakh 50. Similarly, this is for 360 days divided by 360 days. And how much is supposed to be for 30 days? So your creditors have actually become half. If your creditors have become half, so is it good for me or is it bad for me? There is a decrease in creditors, so good for me or bad for me? Good for me? No. Why is it good for me? It is undoubtedly bad for me. If my creditors will decrease, that means I'm making them faster payment. If I'm making faster payments, I'm losing the opportunity cost now. The more credit period my supplier gives me, I'm a happy man. The lesser the credit period he gives me, I am not at all happy. So there is going to be an opportunity cost. So we'll take the difference. Let's take the difference. The difference is, I guess, how much? 1,25,000. Now, do we apply the days or do we directly apply the interest rate on this? So in terms of making this calculations, are we going to directly apply the interest rate, which is given to me at what rate? 4% is the OD rate. So are you going to apply 4% or apply the days directly? That's right. So we're going to directly consider the interest at the rate of 4% on this. So let's see what is the amount on 1,25,000. There is a 4% that comes to 5,000. That is my opportunity cost. So my first working note is done. We have been able to calculate the opportunity cost. Now let's do the cost benefit analysis. So now let's work out the benefits and let's work out the cost. So now let's start counting the benefits and the cost. I think one of the costs we've already calculated is the opportunity cost. So my opportunity cost is to the extent of 5,000. And what is the benefits? Can I say I'm going to get the discount? I'm going to receive the discount. That is a benefit. Now let's see the data. So in the first para, we are given that the discount we are going to get is 0.5%. So tell me, how will you calculate the discount? If you're getting a 0.5% discount, so what amount are you going to calculate that 5.5%? Can I say my annual purchases is 15 lakhs into 0.5%? Correct? That's right. So on 15 lakhs, we will take 0.5%. This is, I think, coming to 7,500. That is the discount I will get, the benefits. And what else? Administration cost will increase by 500. So that's another cost. Your administration cost will increase by 500. But still, I think if we consider the net benefit, so the benefits is A. Let's take this as A. This is the net benefits. And let's take this as B. That is 5,500. That is the net cost. So let's see what is the net benefits in this case. So the net benefit is going to be A minus B. And that's, I think, still 2000. So what do you say? Do we accept the discount policy offered by the supplier? I'm getting a net benefit to the extent of 10,000. Yes, we accept the offer. So we accept the offer of the discount offered by the supplier. Wonderful. So I think this takes care of the inputs in terms of the discount payables management. Now, in this particular question, the next part is pertaining to inventory. I think let's do a question on business valuation. What do you say? Cost of capital done, a bit of working capital done. Shall we change the momentum to do some business valuation question? Yes. So let's do a question on the business valuation part. Great. I'll just share the question to you on a business valuation. So though there are two parts, again, weighted average cost of capital, but I think we're just going to consider the question to the extent of business valuation part. I'll just share the question. I'm sure you would not have done this question also. I think so. Let me share the question on the chat box as well. Please share the full question. Okay, I'll share the PDF maybe. Here is the question on the valuation. Previous one, you want the full one. Okay, I'll share it in the end, not a problem. So let's have a look at this particular question. Have you done this question? Tell me. Look at this question and tell me, have you done this question? I don't think so. Very good. Anybody who's done this question, tell me. The idea of taking, these past examinations was that, you get some new questions to do. I still get one yes. Great if you've done this question. That's brilliant. Okay, so I think let's begin the journey. So I'm just going to read the information. You're going to help me. First, let me go to the requirement of the question. It says calculate the value of closed company using the following method. So we are asked to do a business valuation using a net asset value, using a dividend growth model, and using an earning yield method. So there is a net asset value, there is a dividend growth model, and there is a earning yield method. Now let's read the inputs in the question. It says recent financial information relating to closed company, a stock market listed company is as follows. So you're given the profitability extract in terms of PAT and dividends, and then you're given the financial position, the balance sheet is given. Then it says in the additional information, financial analysts have forecast the dividends of the company will grow at the rate of 4%. And this is slightly less than the forecasted growth rate of the profit after tax of the company, which is 5%. So dividends will grow at 4%, the profits are growing at the rate of 5%. The finance director of closed company thinks that considering the risk associated with expecting earnings growth, an earning yield of 11% can be used for valuation purposes. Closed company has got an equity of 10% and a before cost of debt 7%, 8% bonds redeemed at a nominal value in 6 years' time. Closed company will pay tax at annual rate of 30% and ex-dividend price is given. That is all given for the cost of capital. So I think the last para is not too relevant in terms of calculating the business valuation. Okay. So I think let's go one by one. First of all, net asset value. Tell me what is the value of the business based on net assets. That I think everybody will give me in a second. So we're looking at the net asset value, which is a balance sheet based information. And I don't see that I'm anywhere given in the question any fair market value of any assets, liabilities, nothing. So what do you say? I am given the net asset value. Waiting for answers on the balance sheet. 720 minus 160. Directly 499? Can I take the sum total of equity directly, get the answer? Everybody's thinking too much. Can I say 490 isn't the answer 490? Just take the equity na. Assets minus liability is what you calculate net assets value. So can I directly take 490 as equity? Done. Simple. Just take the sum total of equity, share capital and the reserve. 490 is the answer. Let me just put the answer. So this is question number 4. This is what we're doing on a business valuation. This is what we're doing on a business valuation. So when it says that we need to calculate the value on the basis of net assets basis of valuation, basically net assets basis of valuation is assets minus liabilities, or this is as good as equity, which is going to be a total of equity share capital plus you can say the other equity. Now we can do this because in this particular question, I am not given any fair value of any of the assets. So we can comfortably use this information. So you can take the equity share capital and you can take the other equity in this case. We get the answer directly in this case. So my equity share capital is 80 and the reserves that is 410. So we directly get the answer 490. As simple as that. Okay, now let's go to the next part of the question. Now, the next part of the question is asking you dividend growth model. So now he says, I want the valuation of the business based on a dividend growth model. So tell me, based on a dividend growth model, what are you going to do? Can I say we need what information? We need D1, we need PO, and we need G, right? So let's arrange the data. Let's arrange the data in this case. So we need P, we need PO, we need D1. So we need D1 and we need the growth. So let's organize the data in this case. So let's see what is the, first of all, D1. Let's go back. So am I given the information of dividends in the early start of the question? Yes. What is the dividends of 40 million? Is that D1 or is this D0? That is supposed to be D0. So can I take 40 and the growth rate below is given that dividends will grow at the rate of 4%. So we can say the growth rate is 4%. And we can calculate the D1. This is going to be 40 million into 1.04. I guess that comes to what? 41.6. So 41.6, that's right. So 41.6, that is D1. And PO is something which we need to find out. So this is what we need to find out. So this is what we need to find out. So we'll get the data. So, but we need a KE as well. So let's see what is the KE. So what is the cost of equity? Am I given the cost of equity in the last para? The cost of equity is 10%. So cost of equity is 10%. I think we can finally arrange the data. So, you can reorganize the cost of capital that is supposed to be PO is D1 by KE minus G. So if you want a PO, so you can organize the data. This is going to be D1. This is going to be D1 divided by KE minus G. So what is D1? D1 is supposed to be 41.6 divided by KE, that is 0.1 minus G, that is 0.04. So I think this is going to be 41.6 divided by 0.06. That's right, 693.33. That is the valuation based on dividend discount model. Great. So I think we're done with the second input as well. Now let's go to the third one. So net asset value is done. Dividend growth model is done. Now the earning yield. Earning yield is already given to me. It says it is 11%. Now when you take earning yield, what do? Earning yield means that you need to basically capitalize the earnings. And if you want to capitalize the earnings, the PAT is already given. So should I simply divide 66.6 by the earning yield of 11%, or is there a need to do something else? We've already seen that, when you consider earning yields, there could be a situation with and without growth as well. So are you going to simply divide the earnings that is given in the question 66.6 divided by 11%? Or are you going to consider the growth rate? First of all, add the growth to 66.6 and then divide. Yes, we'll add the growth. So let's go to the next model, and that is earning yield method. So we take the earning yields method. So in terms of the earning yield method, there is a growth rate given to us. And I think what was the growth rate? I think it was 5%. He's giving you that profits are increasing at the rate of 5%. So let's get the value of the business. So value of the business in this case is 66.6 into 1.05. And this is going to be divided by, can I say 0.11 minus 0.05? So we can get the data 66.6 into 1.05, that's 69.93, and we can divide this by 0.06. So this grossed up by this, is it coming to 1165.5, right? Wonderful. So this gives us the valuations, net asset valuations, earning yield method, dividend discount, business valuation also done in this case. Right. So I think I have taken varieties of all these inputs. I think now we can just maybe repeat some questions if you want. Otherwise, the agenda in terms of cost of capital, in terms of working capital estimation, in terms of forex, in terms of business valuations, I think I've taken one question each on these area. So you want to do any further question, or we call it a day and we do investment appraisal tomorrow? Your choice. Forex, another question. Forex, I didn't do too much, because actually Forex doesn't come much in section C. Okay, Arjun, you said, sir, can you give a quick revision on gearing part? Okay, you mean to say the gearing and gearing part? And please explain the risk management and the working capital. Okay, the gearing and gearing. Okay, so let me, I think, just quickly give you the inputs in terms of gearing and gearing. Please share the full PDF of the questions. Okay, I'll do that. Let me do one thing. I selected a few questions today. Okay, it's a good idea. Can I do one thing? I share the PDF to you for all the questions are selected today. And if there are any additional questions, you try them out. If you've not done those questions, maybe tomorrow we can discuss those things as well. Good idea, brilliant idea. So I'm going to share a file to you. So let me share a file out here. See, I've just created a PDF file on which I'm showing you. So I think it'll reach you in some time. Yes, it's reached. Great. Okay, now let me just come to the another agenda which you said on the gearing ungearing part. You see, on the gearing ungearing part, you just need to apply a simple three-step model. You need to apply simple three-step model. Now, what is the three-step model which you need to apply in this case? In step number one, we do what is called ungearing. We do what is called that you ungear. Now, let me ask a questions now to everybody. So when do you ungear in this case? Say, for example, you're in an X business, you want to enter into a Y business, and when you say that you want to ungear, when will you ungear? Because you will be given a equity beta and you need to get an asset beta. So ungearing means that we want, you can say the asset beta from equity beta. But my question is, when do you calculate this ungearing? What is the point when you decide that ungearing will be done? Yes, when there is going to be a different debt equity ratio. If there is going to be a different debt equity ratio, then in this particular case, we will do the ungearing. That is step one. So first you need to watch out that the debt equity ratio is same or not, and then we'll accordingly do this. Now, step number two. Step number two is we need to regear. Regear means we want equity beta. We want equity beta from asset beta in step one. Now, when do you apply this particular step? In terms of regearing, when will you apply the step in terms of regearing? Can I say only if there is a debt, right? So this will be done only if debt is present. Only if debt is present. If the debt is present, then I will regear. And then step number three. Step number three is using a CAPM, and that is to calculate, you can say, to compute risk adjusted K. To compute the risk adjusted K. So this is the basic crux. You just apply the three-step models and you get the results. First, ungear, convert the, calculate the asset beta from the equity beta. And for that, you use a structure. You consider the calculations in this way, that asset beta, we use the formula. Let me put that common formula below. So use the formula asset beta is equal to equity beta, and you multiply this with the in terms of value in terms of equity divided by value of debt, which is 1 minus t, that is taken net of tax, plus the value of equity. So this is a generic formula which you need to use in step one as well as in terms of step two to get the results. So that was a quick revision in terms of giving you how the three-step model is to be done. Please also explain the risk management and the working capital. Risk management is, what we did in terms of Forex. So what we did in Forex was basically risk management, money market hedge, forward contracts. That's all about risk management. Working capital, we did, what we did in inventory management, payables management, receivable management. That is all working capital. You mean the working capital in terms of what? The calculations of the things. I can give you a relationship chart, I think, quickly on that. I got your point. So I think I will give you quickly the working capital relationship cycle. So there is a relationship cycle with which you calculate the operating cycle of the business. So I think let's put that questions across to you. Tell me, I'll give you the item, you give me the relationship cycle. Debtors. What is the relationship of debtors with? That's right, it is credit sales. The next one is creditors. The next one is creditors. So what is the relationship of creditors? Of course, credit purchases. The next one is inventory. I'm now looking at different inventory. I'm looking at raw material. Tell me, raw material inventory linked to what? That is raw material consumed. Correct. So it is going to be linked to raw material consumed. And then we've got the WIP. WIP will be linked to which cycle? That's cost of production. Correct. So that is cost of production. And when you consider finished goods, it is linked to what? Cost of sales. As far as the other items are concerned, for example, if you've got expenses, then the relationship is with the total expense. That is what you need to remember in terms of the relationship cycle. Cash and all will, of course, be given in the question. Right. So I think that takes care of our inputs for the day. I think now you can just take a little rest, and I've shared the assignment with you. Try if you can do some questions. I have a cost of capital doubt. Yes, please go ahead. You want to share the screen? Okay, you can share it on the WhatsApp or you, yes, okay, share the screen. Doubts, yes, you can ask me doubts now. That's, you are most welcome to ask doubts. So what can you expect from 20 marks question? Generally, you get a question on investment appraisal and generally on the working capital. So main areas in section C is investment appraisal and working capital management, comprising of receivables, payables, cash management, inventory management, all of them. Generally, questions on forex or business valuations are less, but you can see sometimes questions on business valuation. But the main marks will be typically from investment appraisal. Investment appraisal is like 99% for sure to come, and invariably working capital. Screen is visible, but I can't read. It's too small actually. Can you zoom it, please? Yes. Yes, yes, that's better. Okay, it says company has a cost of equity 10% and the forecast its future dividends. No dividend in this point three, increasing 3% in subsequent years. Okay. So what is the current share price using a dividend discount model? Okay. So in this particular case, he is taken 0.826 and is multiplied with zero point 0.5 divided by zero point 0.1 and zero point 0.3. So the cost of equity is given to be 10%. So that is KE minus G. And as far as the dividend is concerned, so this is increasing by 3% in subsequent years. Can you scroll a little down on the working? So it says out. Oh. Sir, are there many theory questions in section A and B? How to prepare for it? Well, in FM, you will generally get theory for almost like 35-40 marks in the exam. So, including section C, I'm saying. So AB, how much theory you will get is not predictable, but overall you can expect around 35 to 40 marks section ABC all put together. Like out of 40 marks in section C, the theory marks which you will get generally would be almost around 14 to 15 marks. So out of 40 marks, 14 to 15 could be around theory, rest 25 would be practical. And in section A and B, you will get almost another 15, 20 marks. So that would be the total. Yes, you can share the screenshot on the chat box. I think I'll probably download. Where is it gone? Okay, let me share this on the screen. So I think we were already given the data. What will be a strategy to cover 60-70% score in MCQ? Should we give more attempt or should we do detailed revision on theory chapters? Well, I would say it's a good idea that you should do your section A and B. Uh, Sit down and do the Kaplan exam kit in a single go if you have time. You'll get your inputs on section A and B very strong. Okay, so in this case, I think we are given the dividends were given, I guess, 0.826. That was dividends. Where is the question as well? This is the answer. The difference of first, second year was 0. Third year, I think, was around 0.25, if I rightly remember. He says dividend is, okay, let me also share the, okay. So dividend is supposed to be 0.5 per share, increasing 3% per annum in subsequent years. And second year it was 0.25. Okay. So we are given 0.825 into 0.5. X dividend price is equal to present value of future dividends. That's fine. The first dividend is paid in this, is different in this. Okay, right. Okay, let me explain. Now this dividend which is there, the dividend which is 0.25, can I say this is paid in the second year? So can you just calculate a discounting of this 0.25 at 10% for 2 years? Take a discounting factor at second year end, 0.826. So this 0.826 into 0.5. So this is the present value of the dividend. In this case, we need to consider the present value of the dividend. That's the only catch. So this is KE minus G. So this KE and G is already given in the question. And this is the present value dividends, because dividends are given to you. So we need to take a present value of that money. So the reason of doing this is that 0.5 is paid in third year. So you are given a data regarding no dividends year 1, year 2. So since you are given the dividends, we need a present value of that money. Did you get the answer? I think it's without a two-way communication, it will be a little problematic to deal with this. I think we'll take the doubt sessions other than the revision sessions, I guess. It's better we'll take the doubt session separately. We'll not mix it out here, I guess. Yeah, I think it makes sense. Okay, anyway, friends, I think so that's all. I'm going to see you tomorrow again at 3 o'clock. Tomorrow we're going to do questions on investment appraisal with you. Yes, tomorrow I'll do questions on investment appraisal. So that will be, bigger questions. Today we did some smaller questions. Tomorrow will be the day for investment appraisal. Thank you very much and see you tomorrow. So please make your revisions and see you tomorrow. Thank you. Bye bye and take care.